Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are, our Friday time.
Bob, we're going to start the show off with a listener question. The question, will long-term U.S. rates go lower as the equities market bursts, contrary to popular opinion? Is it time for me to lock in a fixed rate on my variable rate home loan? Also, I lightened up considerably on my gold miners and silver ETF a couple of weeks ago, but I'm holding on to my gold bullion and U.S. dollar cash. I remember that you mentioned in previous Howe Street interviews that gold may act as a safe haven, but the gold miners may possibly decline initially with equities when the bubble bursts. When will it be a good time to buy back the gold miners and silver for the longer term? Thanks.
Yeah, good long question. On the interest rates, yeah, it's sort of like a counter trade. The stock markets and commodity markets have had a sharp correction, but the trade since March really has been to be in long treasuries and in the gold sector. And our view was that if the market becomes troubled, that the careful money would go to the most liquid items, which is gold and the U.S. Treasury market. Now, within the Treasury market, you go from long-dated to short-dated, and in the greatest liquidity is even in the shorter maturities, like less than 1 year. But anyways, they decided that the bond was also, the long end was the place to be. Terrific rally. It's now generating some technical excesses, but when you're in a real financial storm, the long end of the bond market is risky, and the absolute safest place is, of course, in Treasury bills. So here we are up there. We've got this opportunity at some point over the next while, because August can be seasonally a good month for long treasuries, and it is. And then our friend asked about continuing to ride holding gold. Yeah, you want to hold that as an insurance, but like everything these days, you don't get half measures. Things really move. And gold and silver have had good moves. Very popular trade now, and it always surprises me when you see leading spokesmen in the gold business and coming out this week and strongly recommending buying gold and silver at these high levels. It's sort of like they're trying to promote the metals up. But the long bond is close to topping out. Short-dated T-bills are going to continue down, and they're at new lows for the move this week, which is saying that the big boom really is over. And I'm just completing a long historical study, actually updating it from when I did it in 2000, on the wonders of central banking in a new financial era. And the T-bill rate, which is a market rate of interest, goes up with the boom, and then when it turns down, it indicates the boom is more or less over. So the T-bill rate, the 3 months increased to March, and it is really heading down, which forced the Fed to cut its rate merely to look like it's in charge. So at any rate, at any rate about rates, the T-bill rate declining is saying that the boom is as good as over, and the rally in bonds is a terrific opportunity here now. The crowd is buying for two wrong reasons. One, it's a safe haven, but long bond is risky. And the other is that the interest rates in the U.S. at the long end could go down to zero or even negative, as has been the case in Europe. And I don't think that's likely. Gosh, in 2016, in June, that was the tout on the long bond then on a fabulous rally, and it became technical excesses were outstanding. And at that time, we argued that the U.S. Treasury market had so many different players in it and less dominated by the central bank, in which case our technical analysis would work on the treasuries. And if they rolled over and died, so would the bond market in Europe, which indeed worked out. So the big push on bonds in U.S. and Canada was that they would go the way of the European yields to effectively zero. But it worked the other way. So I think the same thing will happen here. So the excesses are building in the long treasury market. And then there will be an opportunity to watch them roll over. But then also our friend had a question on his mortgages, and that's always, at the risk of punning, extremely close to home. But yes, mortgage rates are kind of in between long treasuries and corporates. They're kind of a little bit of a different beast, but they, in a time of distress, those mortgage rates will likely go up, and in which case it's the time to lock in at whatever the low rates are recently. So that's what we would do with your mortgages. But man, the excitement out there, the volatility of things is fascinating.
We'll have more with Bob Hoye right after the break.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, one comment I've heard where I know we've heard that saying, this time it's different, but people are saying the inverted treasury curve might be because so much money is fleeing from Europe and Asia because of negative interest rates. That's boosting the short-term rates in North America. Anything behind that? Yeah,
it's part of the mechanism. You consider you're in a currency that is steady or maybe even declining, because the U.S. dollar has been fairly steady. And the yields are higher than in Europe, so it's the ideal place to be. It's a good trade, but it won't last forever. So we're looking at the technicals, and they're becoming excessive, and also we're looking at the seasonals, which, as I've said, the August for the long treasuries can be pretty good. So, no, this time it's different, as said, at the peak of any powerful movement, and the participants, the market has been so beautiful for them. They're making so much money that you just can't contemplate that this wonderful era is going to end. But you just have to step back from it and say that, yeah, you find this at the peak of every big market event. And look at a year or so ago in Vancouver where, you know, house prices were going to do nothing but straight up. And it's been a fairly sharp correction. So, no, a market is a market is a market, and where it becomes more rational is when you have so many historical examples, and then you have technical measures where you can rationally measure the degree of speculation that's on currently now. So this, of course, is in the stock market as well, which we've been talking, Jim. You've had valuations like relative to GDP or relative to the average wage at higher, very much higher than reached in 2007, and even higher than reached in the crazy market of 2000, that relative to wages, and I think it got up to 107, and then on this move it got up to 128. So, and I think in 2007 it was at 88 or something like that. So you got noticeably much higher valuations, and then of course you always get momentum extremes, which we've had, and then you get sentiment extremes. Now, the sentiment number is pretty interesting because it's a survey of what market letter writers are saying, and the service keeps track of that, and you've had a very high consensus of bullishness, because as it goes higher, the participants are making more money, and those who are writing market letters are more right, and it's self-reinforcing. And then you always watch for the change. And one of them, as you started this with the yield curve going inverted, that's where short rates are get higher than long rates. And that's a standard, and it is a punctuating mark on the progress of the markets, and it's also indelible. Like the curve has inverted, and you can't get away from that. And when it's also part of the big speculation that's going on in treasuries, and of course the trade was earlier out of stocks and earlier into treasuries. It's been a great move, or to the golds. So it's the same thing. We've got the Treasury, got the yield curve back to 1857 or something like that. And yeah, at the end of every business and stock market cycle, you get an inverted curve. And there are some examples in U.S. history where you didn't have to have the curve actually go fully inverted, but just approach and reverse. That was the case last summer. The curve approached inversion, and then when it reversed, that gave the signal on last fall's unpleasantness. And that was also anticipated by the other part of the credit markets, which is your credit spreads, the difference between high-grade and low-grade bonds. Now, this one has really given a signal, because it's in May, we got the first breakout on a possible trend change to widening credit spreads, which is bad news. And then a few weeks ago, we got the second breakout. And as we pointed out, that in 2007, it took the first breakout was the warning, the second breakout said, So we've had the second breakout, and yeah, the market took a whack. And the credit spreads are close to even widening further. So, yeah, this time it's different is actually a signal to really get serious and objective in your views and remove your emotions from it and say, yeah, high valuations, high momentum, and high sentiment numbers that you only get at or near important tops. And then, as we like to point out, Jim, that when are credit crises discovered? Mainly in the fall. So we've had this phrasing that I liked, which would be sunshine in the markets to about mid-year, and then August would turn to twilight. Hey, we've had some setbacks. And then in the fall, the scary program, The Twilight Zone, would be discovered. And this hit in the markets over the last week or so is a very good correction. But some would think it's a buying opportunity because it's been successful to buy the dips for almost a decade. But no, at some point dip buying becomes fatal. And it's possible that this is what we're working on now. Industrial commodities are weak. That was one of our friends of the rally. They might rally out till March or April, and they did. If you take a look at crude oil and base metals, and base metals have been weak. So has cotton. So have lumber prices. So if things were wonderful, industrial commodity prices would be wonderful. So view here on the market action is it had a very sharp hit related to news about the whatever news it is, China and whatnot. But it's technically important, and we're also looking at the deadly season, starting probably in September. So maybe these things can chatter around at this level for a while, but to see it extend the bull market is highly unlikely. Also, the Fed has cut its rate, and gosh, I had a wonderful quotation from that of September 2007 when a big Wall Street figure said, that's it, the Fed is going to cut rates, and that'll keep the bull market going. But that's not the case. While they worry about short rates going up and interest rates getting higher, that's not the case. The rising short rates, particularly, let's just talk about T-bill rates, say that the boom is on. And when they head down, it says the boom's over. And this was the case in 1929 when the T-bill rate went up until that May and turned down in June, and they were down through the summer. And it was effectively saying that boom was over. And then, of course, you had a stock market peak September the 3rd, and then it rolled over and died, and then you had some serious selling pressures end of September and early October of 1929. And then the Fed cut its discount rate, and what was that, 5 months after the bill rate had turned down. And then this time here, the bill rate turned down in March, let's say April, and then recently the Fed cut. So you had 7 months spread from market rates going down to the Fed getting in line with market rates. And this is the absurdity of policy making and central banking, is that so many highly educated people think that the Fed sets interest rates, and yet when you're in periods of high drama, like great financial bubbles, and you just have to look at the history back, and we've got it back prior to 1825 bubble, the senior central bank was the Bank of England, and it was limited by usury laws. It couldn't change its rate above 5%, so you couldn't look at that. But every financial bubble, every big one, the senior central bank was 4 to 5 to 6 months behind market rates of interest. The central bank was really just a passenger on the financial markets.
We'll have more with Bob Hoye right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, you dug up some interesting headlines. India, worst car market in 18 years. China, industrial production output at its lowest level in 17 years. And even Beverly Hills shopping is in a slump. What does this all tell us?
Yeah, it's like we had last week where in Canada you had sales weakening for Tim Hortons, which is a fast food chain, and it was on a lunch trade. And at the same time, there were announcements that Ferrari sales had dropped suddenly. So that's really from basics to high-end stuff. And here now, and that Beverly Hills story was from The Hollywood Reporter, and even the shopping in Beverly Hills, which is very high-end stuff, has slowed down. And again, this is a cyclical thing, and it's fascinating how it works, that all of a sudden ordinary retail sales are slowing, and sales of high-end cars are slowing. So we'll watch and see how it goes. But I think it is a major change, and it's fascinating to watch. And I know that in our historical ones, that in the 1720 South Sea bubble, there was a number of suddenly newly rich people who were playing the game and playing the game well. So these people went out and they bought a grand coach with a fine team of horses and had all of the ostentatious consumption going for them. And then boom, in the fall, the market crashed, and suddenly they couldn't afford this. So there was a used coach area on the outskirts of London where you went to sell horses and sell coaches, and of course that was the case. Now, also I remember in 2000, which was everybody in bubble with the .com thing, and brokers and customers making lots of money and buying very high-end Porsches and Lamborghinis and Ferraris. And then there was an article in the Wall Street Journal that all of a sudden in that fall, there was a lot of Ferraris and Porsches and Lamborghinis that were coming, the guys couldn't pay the lease on these things. So we're watching for some problems even in the high-end car market.
Bob, thank you so much for chatting with us.
Jim, it's good to be with you, and we're looking forward to next week.
My guest has been Bob Hoye. He's the Chief Investment Strategist for chartsandmarkets.com. If you have any questions for Bob, and you can see we get quite a few every week, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.